All right, let's talk about something that's always working in the background of your financial life. It's this silent force that can quietly, and I mean quietly, drain your wealth. And no, it's not some dramatic market crash, it's inflation. And today, we're going to break down why it's way more dangerous than you might think, and more importantly, what you can actually do about it. The comedian Henny Youngman had this great line decades ago, and it just perfectly sums up the problem. It's funny, right? But it hits on a serious truth. It's not that we're getting stronger, it's that our money is getting weaker. Every single dollar you have buys a little bit less today than it did yesterday. And look, I get it. For what feels like forever, we've been hearing that inflation is dead. The official numbers have been pretty low, and it kind of feels like a problem for the history books, not for right now. But that feeling of safety? That can be one of the biggest risks in your entire portfolio because complacency is the absolute enemy of a smart investor. To really get why we're so good at ignoring this threat, we have to look at our own psychology. It turns out our brains have this built-in blind spot when it comes to inflation. Psychologists actually have a name for it. They call it the money illusion. Okay, so check this out. Let me ask you a question. In scenario A, you get a 2% pay cut, but prices for everything stay exactly the same. In scenario B, you get a 2% raise, but prices go up by 4%. Now be honest, which one would you choose? Which one just feels better? Most of us, our gut reaction is to pick scenario B. And here's the crazy part. In both scenarios, you are exactly 2% poorer. Your actual ability to buy things drops by the same amount. See, this is the money illusion in action. We focus on that nice, positive number, the 2% raise, because it feels like a win. We tend to completely discount the real result after inflation. It just eats away at our wealth in secret. So if our brains are basically hardwired to ignore it, why should we force ourselves to pay attention right now? Well, I'm going to give you 3 really powerful reasons to believe that the risk of inflation is far from over. We're going to look at 3 things here. First, a pretty painful lesson from not-so-distant American history. Second, the fact that this is a global issue. And third, a kind of cynical, but let's be honest, accurate look at how governments actually benefit from inflation. First up, let's talk history. It wasn't that long ago, from 1973 to 1982, that the US got hit by a brutal wave of inflation. Prices more than doubled in that time. In one single year, 1979, they shot up over 13%. Just imagine that. By the time it was over, a dollar from 1973 was worth less than 45 cents. That's a massive destruction of wealth. Second, and this is important, this is not just an American problem. When you look at the whole world, the data is even more shocking. Since 1960, nearly 70% of the world's market economies have had at least one year where inflation went over 25%. On average, those events wiped out more than half of an investor's purchasing power. We would be nuts to think it could never happen here. And reason number 3? Well, it comes down to the government's own self-interest. Just think about it for a second. If you're a government with mountains of debt, rising prices are secretly your best friend. It means you get to pay back all those huge loans with dollars that are worth way less than the ones you borrowed. So getting rid of inflation completely, that actually works against the economic interests of any government that borrows money. So what's an investor supposed to do? Well, the standard advice you always hear is, oh, just buy stocks. And that's not terrible advice, but it's not the whole story. The idea that stocks are this perfect, foolproof shield against inflation, that's a bit of a myth. This chart shows it perfectly. It's looking at stock returns versus inflation all the way back to 1966. And as you can see, stocks do terribly when prices are falling. That's deflation way over on the left. They do fantastic in the middle with just a little bit of mild inflation. But now look what happens on the right. When inflation gets too hot, say above 6%, stock performance gets really unpredictable, and often it's just awful. Now, if we look at longer time frames, yeah, stocks have beaten inflation about 78% of the time over any 5-year period. That sounds great, but it's not 100%. It means that for about a fifth of the time, nearly 22% of the time, your stocks actually failed to protect your buying power. That's a pretty big risk to just ignore. So what can we do? The good news is you can absolutely strengthen your defenses. There are 2 really powerful tools every investor should know about, and they both have easy to remember acronyms: REITs and TIPS. First up, we've got REITs. That stands for Real Estate Investment Trusts. These are basically companies that own and operate properties and collect rent. Think about it. When inflation is pushing prices up, what else usually goes up? Rents. And that makes REITs a pretty solid defense against your purchasing power getting eaten away. Second, we have TIPS. That stands for Treasury Inflation Protected Securities. These are special U.S. government bonds. They have this amazing feature where their value automatically goes up when inflation rises. This gives you a direct, guaranteed way to make sure your investment keeps pace with rising prices. It's a real inflation killer. Now, there is one little catch with TIPS you have to know about. The IRS sees that annual inflation adjustment as taxable income for that year, even though you haven't sold the bond and don't have the cash in your hand yet. So because of that tricky tax rule, the best place to hold TIPS is in a tax-deferred retirement account, like your IRA or 401k. Okay, so how do we put all of this together into a real plan? Let's build a simple, intelligent strategy to make sure you're not just earning money, but you're actually keeping what you earn after inflation takes its slice. So here's your checklist, your game plan. Number 1, don't just own stocks, diversify. Number 2, think seriously about adding a REIT fund for that real estate exposure. Number 3, use TIPS as a super safe replacement for cash in your retirement portfolio. And please remember, hold those TIPS in a tax-deferred account. A really good rule of thumb is to put at least 10% of your retirement money into TIPS. It's just a smart way to keep that chunk of your savings completely safe from those invisible claws of inflation. And that really leaves us with one final big question to think about. It's easy to focus on our paycheck and whether it's going up. But the real test, the real challenge is making sure your entire life savings, your portfolio, is actually built to protect and grow its buying power for the long haul. Is it really built to keep what it earns?